Let's break down trading logic in the most straightforward, easy to get way so you can understand it, remember it, and use it to make trading simpler. Left side trading and right side trading. Aren't these the most common trading approaches? You've probably heard, when others are scared, I'm greedy, and when others are greedy, I'm scared. Think that sums up left side trading? Or is that right side trading just chasing pumps and dumps during crashes? No, these are just the surface level basics. In this video, we'll use the simplest words to explain the logic and pitfalls of left side trading and right side trading crystal clear. Before we start, let's quickly explain what left side and right side trading are for newbies dipping their toes into trading. Left side trading, put simply, is buying the dip. When a coin or stock price drops to what you think is a dirt cheap price, you start buying. The more it falls, the more you scoop up. Then you sit tight, waiting for the market to heat up, for the excess true value to show, and you cash in on the profits. Right side trading, a favorite of seasoned traders, is what's called trend trading. What's that? It's when a coin or stock is already climbing, with indicators shooting up, and you jump in decisively. Right side trading doesn't waste time waiting. You just grab the trend and eat the profits. For retail investors, right side trading is obviously more capital efficient and generally brings better overall returns. Some investing big shots like Warren Buffett are pros at left side trading. But why do regular retail investors often get stuck in a rut trying it? 3 main reasons. 1. It's tough to know the value zone. Retail investors just don't have the research power, industry know-how, or deep info resources that institutions do. A lot of times, what you think is a low price is just your own guess. You think you've hit the bottom, but it keeps dropping. Retail investors rarely have a solid grasp of what's truly cheap and often rely on gut, emotions, or online buzz, which isn't dependable. Meanwhile, big institutional players have way more info and a clear edge. 2. No patience, no follow-through. The core of left side trading is holding patiently, waiting for the fundamentals to kick in, for the market to turn, and dealing with long-term paper losses. Big funds are way better at timing these cycles. How many retail investors, even if they snap a good asset, start second-guessing when it keeps falling before a clear bottom forms? They get rattled by the market noise and bail out early in the rebound. By the time the real rally hits, their chips are long gone. Big funds, on the other hand, actively hold through short-term dips without blinking. Most retail investors end up passively stuck, suffering through a brutal washout. When the price finally claws back to their cost, they're quick to dump. In the end, their so-called left side plan just turns into getting trapped at a low price, and when they break even in bold, their profit potential is tiny. 3. Sunk costs aren't worth it. For institutions, left side trading is about building a cheap position for the long haul. They've got huge capital and can afford to wait. Retail investors, though, can just pick assets that are already rising to maximize their money's value through trend trading. Another big reason institutions lean toward left side trading is their capital size. With massive funds, chasing right side trades might mean there aren't enough chips to buy. Left side trading lets them grab chips during panic-driven drops, buying from pessimists and selling to the optimists until the market balances out and bottom forms. Of course, retail investor can do left side trading if they've deeply studied a specific asset, are clear on its future value, and start building a position during a downtrend. That's totally doable. Compared to left side trading, right side trading is way more suited for retail investors. It's like moving to the market's beat. The market's already picked its direction and you just follow. First, get this. A price going up isn't always about how great a company or project is. It's purely about money betting on what coin or stock. That's why you hear folks gripe about great narrative or big market cap access not moving. The root of any price surge is funds piling in, naturally forming a price trend. That's right side trading, aka trend trading. Money flowing in and out has a cycle, and so does a trend start and end. Right side trading is about jumping in when the cycle begins and getting out when it's done. So what are the perks of right side trading? 1. Ride the trend, don't guess the bottom. Left side trading means buying in a downtrend, but those paper losses can turn real. If you're out of cash and need money fast, you might have to sell your chips while the price is still falling or before you're in the green, stuck in the awkward spot of cutting losses early. 2. Skip constant stop losses. and paper losses. Retail investors aren't great at judging if an asset is solid or not. That's where big money shines. When a stock or coin price climbs up with growing volume, it means smart money has already done the deep dive and decided it's worth buying. No big fund is dumb enough to blindly take over a position. They crunch the numbers carefully before jumping in. So, telling big funds picks is way more likely to make money than picking based on your own fundamental analysis. 3. Hold steady for max profits. Some folks get spooked when prices climb too high and sell early because it feels too much. That's normal. When prices go beyond what you know, you panic and want to crash out. But deep down, this kind of selling, compared to left side trading, where you jump as soon as you break even after being stuck, less you hold longer and make bigger profits. Nailing right side trading isn't as easy as it looks. Top right side traders don't just scroll through the daily gainers list chasing breakout trends. Instead, they put fundamentally solid assets on their watch list and wait for the right side buy signals to show up. 1. Confirm trend signals. Don't jump early. A price hitting a short-term high, breaking through a long-term trend resistance, and moving averages turning upward. These 3 are must-haves for a clear trend breakout signal. The rule of right side trading is to buy only after the signal is crystal clear, not to sneak in early or lurk beforehand. 2. Watch for volume spikes. Any uptrend comes with growing volume, and a trend's end comes with shrinking volume. That's a hard rule, because that's how money cycles from coming in to heading out. 3. Don't double down on fake breakouts. Sometimes it looks like a breakout's happening, but after you buy, the price tanks. In this case, don't add to your position. If it's an asset you're bullish on long-term, you can lie low and wait patiently for the next trend buy signal. If it's a short-term play, you might face the risk of cutting losses. Right-side trading is a group of vibe of capital piling in, forming a trend that creates a short-term price premium. Left-side trading sounds like a high-value move in theory, but only if you can know the value zone, wait patiently for it to pay off, and handle long-term swings. Most retail investors just don't have those skills. Right-side trading is more like a practical, ride-the-wave strategy. It doesn't care about value or predict the future, it just goes with the flow. For retail investors, it's about spotting the trend, sticking to the plan, and managing risk. Jump in after the trend's confirmed, get out before it fades, and grab the waves profits in between. Sure, at the absolute bottom of a bear market, retail investors with a smaller capital can pivot fast and try left-side trading. But that only works if it's a project you really know, have deeply researched, and are confident in its future value. Otherwise, left-side trading is just another way to bet on luck. The ones who truly make it in the market are the ones catching bottoms. They are the ones riding trends, waiting patiently and pulling out at the right time.